My name is Philip Deturi. I am the Director of Education at PhiCycle, and today I'm going to be giving a talk which we call Wealth Not Cash. We need to understand four key concepts. That is income, expense, asset, and liability. So let's go through them now. The first is income. Income is an increase in wealth. When you receive goods, when you receive income, your ability to consume goods increases. So the most familiar form of income that most people don't struggle with is a wage. If I have a job and I get paid $5 an hour and I work for 2 hours, someone's going to give me $10, and now I have $10 more with which to consume. But wages aren't the only reason that you have an increased ability to consume. In fact, anytime you receive cash or something of value without giving up something in exchange, this is income. So students love silly examples, but if you steal money from your sister and she doesn't find out, that's income. If you rob a bank and don't get caught, that's income. If you find a penny on the floor and pick it up, that is income. Another very important source of income is income that comes from financial instruments, such as investments, retirement funds. How do you know if something is income? Use the definition of wealth. Stop and ask yourself, when my financial situation changes, is it now possible for me to consume more than it was before? If so, then I have received income. The flip side of income is expense. Expense is defined as a decrease in wealth. When you incur expenses, your ability to consume goods decreases, your wealth decreases. The most familiar kind of expense is when you spend cash and immediately consume something. Again, I'm going to use the pizza example or the food example, right? I spend money on food, I eat it, that's an expense. However, whenever your cash decreases without you gaining something of financial value in return, it's an expense. So to go back to those silly examples, if someone steals from me, that's an expense. If I decide to throw a penny in the fountain to make a wish, that's an expense. If I give money to someone begging for money on the street, that is an expense. Similarly, if I go to an ATM and I take money out from an ATM and they charge me a $2 fee, that's an expense. Now, it's important to note, however, that if you spend cash on something and it retains value, it's not an expense. So I can give the example of a house. If I buy a house and it retains its value, then it wasn't an expense because I still have the same amount of wealth. If I buy let's say a $50,000 house, I then own a $50,000 house. I had cash that was worth $50,000, and now I have a house that is worth $50,000. My wealth has not changed in that case. You are only experiencing expense if your ability to consume decreases or your cash decreases. So again, we can use the same heuristic we used for income. How do you know when something is an expense? Use the definition of wealth. If your financial situation changes, you stop and you ask yourself, can I consume more or less than before? If your ability to consume has decreased, you have experienced an expense. Both income and expense involve changes in wealth. We also need to be able to figure out what our wealth is at a fixed point in time. While we can describe changes in wealth with the terms income, expense, we will need assets and liabilities to discuss our wealth at a fixed point in time. So what are assets? Assets are property that stores value or reduces expenses. The more assets you have, the greater your wealth. Now, the most familiar kinds of assets are assets that you can take and then sell at some point in the future. So a car, gold, house. These are possessions where we commonly in our society acquire them and then sell them. And you can use the cash you get from selling them to fund your consumption. On that point, cash itself is an asset since it is storing value. However, cash is a very special kind of asset, so we often treat it separately, but it is an asset. It contributes positively to our wealth. Property can also be an asset if it retains value over an extended period of time, even if it can't be resold. My favorite example for this is a computer. Many people in our world own computers that are old, maybe 4 years old. I have a friend who does this. She still uses her computer to check email and browse the web. However, she could not sell it. It's too old and too slow. No one would buy her computer. However, if she didn't have it, she would have to go get a computer in order to check her email and browse the web. So in this regard, her property is reducing her expenses even though she can't trade it to someone for cash. If she didn't have this computer, she would have to go spend her other resources on another computer. So in this regard, this property, a computer that can't be resold for a significant sum, is still reducing expenses, still can be considered an asset. Liabilities are the flip side of assets. They are obligations to make future payments. They are your debts. The greater your liabilities, the less your wealth, since the money that you have will be used to pay them off and can't be used for consumption. So again, we have assets which contribute positively to our wealth, and liabilities which are contributing negatively to our wealth. They usually come from borrowing cash, and unpaid liabilities usually increase over time due to interest. Let's stop for a second and see how well we understand these concepts. So I'd like you to please quiz yourself at home. I'm going to go through this kind of quick, but you can pause the video to stop and think about and even just respond to these questions. What we're going to do is we're going to look at 6 situations, and then we're going to ask ourselves, is our cash balance going up, down, or staying the same? U stands for up, D stands for down, and S stands for the same. And then we're going to decide, are we earning income? Are we acquiring a non-cash asset? Notice that acquiring an asset, I specified non-cash. Are we incurring an expense? Are we increasing liabilities, or is none of the above happening? Let's start with number 1. You're paid $5 an hour for 3 hours of babysitting. What's happening here? Well, I'm working and then I'm getting paid money, so my cash balance is going up. And because my cash balance has gone up, I have more money with which to consume, so I should be earning income. Let's take a stab at number 2. You buy 2 slices of pizza for $2. And we're going to go ahead and assume that you eat them. So what's happening? Well, certainly I spent money, so my cash balance is going down. And I am going to be eating this pizza as soon as I buy it. So I am incurring an expense because my ability to consume after having eaten the pizzas is now less. I have 2 pizzas less ability to consume, or $2 each less to consume. Let's see what we got. Yeah, my cash balance goes down and I'm incurring expenses. All right, so now let's say you live in New York City and you buy a 1-month subway pass for $100 that you're going to use to get to school every day. So first, I spend $100, so my cash balance is going down, but I'm getting a subway pass that I'm going to use to get to school every day. If I didn't have it, I'd have to pay for the subway and buy another subway pass. So this is going to be reducing my expenses. I'm giving away $100. And I'm getting a subway pass worth $100. I'm not incurring an expense because my ability to consume is the same. My cash balance is going down, but I am acquiring a non-cash asset. That subway pass is going to act in some sense like money as I use it to get on the subway every day. Okay, next, number 4. You sell your computer to a friend for $200, a fair price. Now, the fair price is very important there. I'm selling a computer worth $200, and in exchange, I'm getting $200. So, has my ability to consume changed? It hasn't. Now, I'm turning a computer, which is contributing positively to my wealth as an asset, into another kind of asset, cash. The fact that it's fair means I'm not gaining money or losing money on my friend. Now, unfortunately here we say we are acquiring a non-cash asset. So I'm acquiring cash, and so what's happening here is none of the above. You see, our cash went up, but because we lost something worth $200, our wealth did not change. Your friend lends you $10. What's happening here? My cash is going up by $10, but I'm also acquiring an IOU, a debt, to my friend of $10. So while my cash went up by $10, I acquired a liability which contributes negatively to my wealth by $10. In the end, my wealth hasn't changed, so I'm neither experiencing income or expense. In fact, what I have done is my cash has increased, but I have also increased my liabilities because I now owe my friend $10. You earn $5 interest on your savings. So what's happening here? My cash balance is going up, and I earned $5 interest. Did I give anything away in exchange to earn that $5? No. So my ability to consume has increased by $5, therefore I am earning income and my cash balance has gone up. If as we were going through these activities, you're looking at them and you said to yourself, well, okay, but what if I don't eat the pizza? Then it's still worth $2. Or, all right, well, what if I've already used the subway pass? You're right. We can add sentences or take sentences away to these little stories to try to change where it would fall on this grid. And if you're a teacher and your students are doing that, that's not bad. What they're actually doing is showing you that they understand. So let me give you an example of what I mean about how we can have more backstory and it can change what one of these little situations are. In general, if you're a teacher and you're going to be doing this with your students, you really have to stress that we're going to assume that only the situation as described happened and that there's no other backstory. Inevitably, your students will add backstory. So let's see what happens in a situation like that. So now you go and you buy these new limited edition LeBron James sneakers, and I want to know, what kind of transaction is this? It really depends. Let's say you buy these new limited edition LeBron James sneakers, and then you use them to play in a very important basketball game at the YMCA. In this case, you've incurred an expense. You paid for sneakers, and then they lost value when you used them. What if instead you buy them with the intent to sell them to your brother and you never wear them? Well, in this case, you've now acquired an asset because those sneakers are storing value. What if you buy them with the intention of selling them to your brother, but you buy them for the asking price of almost $500, and then your brother is only willing to pay you $300? In this case, you first acquired an asset, but then you incurred an expense when you sold them for less than you purchased. What if the opposite happens? You buy them and you intend to sell them to your brother for $300, but you get them through a connection at the store and you only pay $225. Well, now it's very similar to the last example. You've acquired an asset, and then you receive income when you sell them for more than you paid. They're initially storing value, but then when you sell them for more than you paid, they increase your ability to consume.